Welcome to the show. I'm Mitch Goldberg, financial advisor with the wealth management firm Client First Strategy. Stocks tank. Most stocks have been going down as of late. We've been warning about this. Really, we have if you watch the show. More important, what should you know? What should you do? So we're going to roll a quick introduction, and then we're going to talk about everything that happened today, put it in perspective with the Federal Reserve and why so many investors are disappointed and what really what gave the excuse for investors to start dumping stocks, especially the big tech stocks, the big AI stocks that have gone up a lot. So here we go. All right. Thank you so much for joining me. It's a pleasure to have you with me. Let's talk about the market today. So stocks tanked, Dow down over 1,000 points, and Nasdaq down over 3.5%. Those are pretty big days. So I could legitimately say stocks tanked today. 1% move in the major averages doesn't really get my attention, but 2% move definitely does. 3% moves in a major index. Now you have my attention for sure, and I think it needs some little bit better explaining. By the way, you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. So a couple of things that happened that came to a head. First of all, the Dow's been going down every day. I think it's 10 days or 11 days in a row. We haven't seen something like this since the early 1970s. And it's a pretty extraordinary thing when you hear a statistic. This hasn't happened since the 70s. So what's going on with the Dow? First of all, I don't think the Dow is really a good measure of the stock market. But I know what you're thinking. If I don't think the Dow is a good measure of the stock market, then I must think that the S&P 500 is a good measure of the stock market. I don't like either one of them. And I think they both have presented a set of circumstances and in particular risk, especially with the S&P 500. The S&P 500 used to be to me a highly diversified index where you get 500 of America's best leading companies. You had to do well as a company for investors to want to buy your stock and to make the stock go up. And then eventually companies would be big enough to join that venerable index. But what happened is what happened is that tech stocks have become such a big component of the S&P 500. It's something like 30%, and if you include communication stocks like I think Meta and Netflix, it's even higher. And then you look at all the stocks that are up on account of the artificial intelligence boom, which so far, the boom we've seen in artificial intelligence has really been strictly limited to the stock market, and in particular to a handful of large cap companies like the ones we talk about all the time: NVIDIA, Amazon, Microsoft, the companies. But when it takes off, you'll know, because Walmart and Target and Toyota and other, Procter & Gamble and other big companies will start to use artificial intelligence to streamline their businesses and become more efficient and make more money for shareholders. I don't think we're at that level yet. And I think the adoption of artificial intelligence is going to be taking a lot longer than what the stock market is indicating. So if the opportunity in artificial intelligence is worth trillions of dollars and the stock market valuation has gone up by trillions of dollars because of that, isn't it fair to say that the gains in the stock market have already been realized? And now where do we go? It took the internet, a decade after the tech bubble to really come into its own and to start to be the internet that we think of it as today. And that same thing will probably happen with artificial intelligence. 10 years from now, there'll be some great applications besides just Chat GPT, but it's going to take a while until companies even start to fathom how they could use artificial intelligence in their actual day-to-day business operations. It's going to take a long time, and everybody's trying to get in on it. So we'll see what happens. So you have overvaluations, and I always say that valuation is not a good timing mechanism. It's an overvalued stock or market could keep becoming more overvalued, and an undervalued stock market could keep becoming more undervalued. What valuations mean is that if there is a change in direction, valuation is a determinant of how intense the move could be. So if an overvalued stock market goes down, usually the downside move will be more magnified depending on how overvalued the market was to begin with. So an overvalued market would go down a lot on bad news, and an undervalued market, I should say, could go up a lot on good news. So take that for what it's worth. But if you have a market that reacts so sensitively because the Federal Reserve met today, they cut interest rates for the third time this year. They cut a half a point, then a quarter point, then another quarter point today. So that's one full percentage point in the federal funds rate. The thinking was they would cut 4 times next year, but now it's going to be maybe 2 times. When you have stocks that are such lofty valuations that really need interest rates to be cut in order to justify valuations, well, they react very negatively when they don't get that special treatment of more rate cuts. So that's another thing that happened. The other thing is recently NVIDIA came out with earnings, and earnings are still up, like the revenues are up like 100%, 106%, but it wasn't good enough. The stock went down still because, when you expect a company to do even better than that, it's all about expectations, and expectations are just too high for a lot of these companies to meet. That's another reason why these stocks have come off. What else? I think investors resisted selling these stocks because they thought they could put off tax selling pressure, capital gains taxes until next year. But now they can't wait because so many other stocks have gone down. The advanced decline line of the overall stock market has been going, especially with the NASDAQ. The NASDAQ has been going lower and lower and lower, while the price has been going higher and higher and higher. This is the international sign language for lower and higher, right? So that is what happened. So as more and more stocks started to deteriorate, you didn't notice it because in the averages, a couple of big cap stocks, mega cap stocks, were holding it up. But if that's not the case, then there's really nothing to hold up the stock market if these large cap stocks give up the ghost. So we've been talking about this so many times lately in the last few months about, some of you have such big profits in some of these stocks that it's time to take something off the table. I went over a lot of mutual funds with a lot of clients in the last few months to go over their holdings, and they're surprised that every single stock fund that they have has the same 10 stocks that lead that in the top 10. It's always the same. It's Meta, it's Nvidia, it's Microsoft, it's the same stocks, Visa. So people are not, just because you own 10 different mutual funds doesn't mean you're diversified. If they're all trading in the same stocks and have similar performance this year, it really means you bought the same thing 10 times, not buying 10 different things at the same time. There is a difference. And then you look at the other investments that track the NASDAQ 100, the S&P 100. These are all very, very tech dominant. So we were due for the correction. Now, is this a correction? Well, that's a tough call because a down day feels like the start of a correction, and it could also feel like the start of a bear market. My own sense is, this is what a correction looks like, and this is what it looks like when a bubble starts to burst. I've seen investment bubbles before. I was 33 years old during the tech wreck, and I saw what that did to people. I saw what it did to client portfolios, and I saw what that did to investor confidence, and it took over a decade for investors to regain their confidence. Cash levels on the part of institutional investors and individual investors is running at a record low, which means people are extremely optimistic about stocks and are fully invested. From a contrarian point of view, it tells you that when there's not much cash left to go into the market, which is fuel for stocks, stocks could go down because now investors want to raise money. And a day like today, with selling accelerating into the end of the day, it appears that investors are really just unloading whatever they can now to raise cash because they don't want to give up all the, they don't want to give up a lot of the amazing gains that they've gotten so far this year. I think that's what's happening. Will it continue? Listen, we're not here to tell you these things, what the market's going to do tomorrow. We're here to talk to you about how you could stay invested for the next 10, 20, or 30 years or more. When I tell people I invest, I'm looking to invest for diversification, not investing for returns. I invest for diversification. It's part of my process. I surrender the results and I trust the process, which we've honed over many, many years and is doing a lot of good for clients. And we're going to continue that, always making refinements. So that's why the market went down today. Do you have any other things that you want to add to why it went down, or it was due for a pullback? You had the right confluence of events, weakness in NVIDIA, weakness in the Dow, a weak advanced decline line. But what led to it, what really accelerated it, was the Federal Reserve pulling back on its forecast for interest rate cuts. And once that happened, that was all the reason investors needed to start bailing out on even their large cap, mega tech, artificial intelligence stocks. And that's really what happened today. All right. So I'm going to leave it there. I'll have more to say about this in the coming days. We'll see how things unfold. I want to talk to you about the Dow and a few other financial market mechanic things that we'll get into. All right. Have a great day. And thank you so much for joining me.